How does a huge financial institution, like a real behemoth, actually manage to pivot, especially when things are changing fast and everyone's watching? It's not easy. It's like turning a giant ship in a busy harbor. Welcome to the Deep Dive. Today we're getting into TD Bank Group's Q3 2025 results. And look, this isn't just a numbers game. We're talking about a major bank going through some really significant strategic changes, plus dealing with a lot of regulatory stuff. We've gone through their official Q3 earnings presentation, the news release, bits from the conference call too. So our mission for you today is pretty straightforward. Cut through the noise and pull out what really matters. You'll get the picture on TD's performance, their strategy shifts, how they're tackling big challenges like compliance and, the economic climate they're working in. Think of it as your shortcut to understanding a bank in, transformation mode. Okay, so let's start with the big picture. The headline numbers for Q3 2025. What's the story when you look at reported versus adjusted earnings? Well, reported net income was $3.3 billion. That's a huge swing from a loss last year, about $181 million loss then.
Right. Then the adjusted net income, that came in at $3.9 billion, so up 6% year over year. Similar story with earnings per share, EPS. Reported was $1.89, way up from a loss last year. Adjusted EPS hit $2.20, up from $2.05.
Yeah, and that gap, between reported and adjusted, that's really the first big clue. It immediately tells you there were some significant items of note, as they call them.
Mm-hmm.
It signals that TD is actively managing some major transitions. The reported numbers show the cost, sometimes the pain, and those changes may be write-downs, integration costs.
Right.
But the adjusted figure, that's management saying, look, strip out these big strategic moves, and the underlying business is actually performing pretty well. It shows resilience despite all the upheaval. It suggests they're okay taking some short-term hits for what they hope is a better long-term position, which is, frankly, a bold move in banking today.
And the CEO, Raymond Chun, he echoed that. Said something like, strong performance driven by robust client activity and disciplined execution. He emphasized being well-positioned to build on this momentum. Compete, grow, and build our bank for the future, clearly framing these changes as foundational.
Okay, let's dig into those items of note, because like you said, they're not just footnotes, are they? They really reflect big decisions.
Exactly.
We're talking amortization of acquired intangibles, charges from the Cowen acquisition, impacts from that terminated FHN deal's hedging strategy.
Right. That one didn't go through.
And then the U.S. balance sheet restructuring, plus general restructuring charges. These are the things management pulls out to show, the core operational performance.
Yeah. Think of them as entries in TD's strategic diary.
Mm-hmm.
The U.S. balance sheet stuff, for instance, that's not just accounting. It's like they're actively pruning and reshaping their assets there.
And the Cowen charges? Yeah, they hit reported earnings, but it's an investment, right? An investment in bulking up their wholesale banking side. So these aren't just costs. They're strategic moves, investments, divestments that they believe are crucial for the bank's future health. It really shows a deep rethink of their priorities.
So connecting that to the bigger picture, what does this mean for their long-term strategy? You mentioned these decisive actions in fiscal 2025. What are they focusing on?
Well, a big one is structural cost reduction. They've flagged, $550 to $650 million pre-tax in annual savings expected from this restructuring program?
That's a significant number.
It is, and it came with a cost in Q3. $333 million pre-tax in restructuring charges. Mostly severance, some asset impairment, winding down certain businesses, optimizing real estate. It also meant about a 2% cut in full-time staff, mostly through attrition and moving people around.
So if you tie that all together, it paints a picture of a bank laser-focused on streamlining. Optimizing capital, getting rid of non-core stuff to boost future returns. It's a pretty major reshaping of the business model, really. Not just trimming the edges.
No, not at all. It feels more fundamental. This kind of overhaul is never easy, but it's often necessary, especially when you're dealing with, regulatory pressures too.
And it's not just costs, right? There's been a shakeup in leadership too. Yeah. Accelerated CEO transition, 5 new directors, new board chair. Plus, they're changing how they use their capital.
Mm-hmm.
Selling that 10.1% stake in Schwab was huge, released about $15 billion in capital. That resulted in a net gain of roughly $8.6 billion back in Q2 and boosted their CET1 ratio, that key capital measure, by around 238 basis points.
Yeah, the Schwab sale is a classic capital optimization play.
Right.
It's like, okay, this was a good investment, but does it fit our core strategy now? Maybe not. So sell it, free up the capital, and use it to strengthen the core bank or return it to shareholders, which they're also doing.
Exactly. That $8 billion share buyback program, the NCIB, They bought back 16 million shares just in Q3.
So redeploying that capital, showing confidence, it all ties together. Streamline, optimize capital, focus.
And that focus extends to simplifying the business portfolio,
Yeah.
really looking hard at return on equity. They sold off about US $9 billion in correspondent loans,
Okay.
another US $8 billion in other loan sales and runoffs. They're even winding down that point-of-sale financing business in the U.S. But it's not all cuts. They announced a strategic partnership with Fiserv for their merchant solutions in Canada. So investing where it counts.
That shows real discipline, doesn't it? Shedding assets that maybe aren't core or don't hit the ROE targets. It's not just simplifying, it's sharpening their focus, concentrating their capital and efforts where they think they can win. It's a clear sign they understand their strengths.
So we've talked strategy, the big picture moves. How is this actually playing out in the different business segments? Where are things clicking and where are the big challenges? Let's start with Canadian personal and commercial banking. Sounds like a standout quarter there.
Absolutely. Record setting, actually.
Yeah, record revenue, record earnings, $1,953 million, up 4% year over year. Record deposit and loan volumes, too, both up 4%.
Strong growth.
And strong digital engagement record, year-to-date digital sales for things like checking, savings, cards, good growth in mortgages, RESL, and 7% growth in card loans year over year. That's a lot of records. So is it fair to say the Canadian business is kind of the engine right now, providing the stability while other parts, especially the U.S., are undergoing major surgery?
I think that's a very good way to put it, yeah. The Canadian P&C segment is the anchor. It's showing solid organic growth, great digital traction, and it throws off consistent, reliable earnings.
Right.
That stability, that capital generation, it's absolutely vital. It gives them the buffer, the flexibility to fund that massive remediation effort down in the U.S. without completely tanking overall profits. Without that Canadian strength, the U.S. overhaul would be, well, much, much riskier.
Okay, let's pivot to U.S. retail then, because that definitely sounds like a more complicated picture. Restructuring, remediation, that seems to be the theme.
It really is.
Net income, if you exclude Schwab, was US $554 million. Now, that looks like a big jump from last year, but that's mostly because last year had those big BS-AMLA charges.
Right, the comparison base is low.
Exactly. If you look at adjusted net income, it was actually down 18% year over year, and they're saying that reflects higher spending on governance and control.
And that really raises the core tension, doesn't it?
Yeah.
How do you manage the immediate cost, the drag on earnings from a huge remediation project like this while still trying to grow the underlying business?
Yeah.
The U.S. retail story is a clear illustration of that balancing act. It shows just how long-term and expensive fixing these kinds of regulatory issues can be. It's a major commitment.
And they are making moves on the restructuring side there. Sold off loans, paid down borrowings. They finished repositioning their U.S. investment portfolio, sold about U.S. $25 billion in bonds since last October, took a loss, about U.S. $1.3 billion pre-tax. Yeah, but they expect it to benefit net interest income by around U.S. $500 million this fiscal year. So a trade-off. Total U.S. assets are down to around U.S. $386 billion, heading towards their target. And they're winding down that point-of-sale finance business, too.
These are all deliberate steps, you know? Reduce assets, simplify, enhance future profitability, even with that upfront pain. It's about rebuilding the foundation in the U.S., making sure it's robust, compliant. It really speaks to a fundamental reevaluation of their whole U.S. operation.
And the core of that is the BS-AML remediation. Still priority number one. Still a massive investment. U.S. $500 million pre-tax expected this year and next year.
Wow, okay.
They hit some Q3 milestones. New transaction monitoring system is up. Started using machine learning there. But look, this isn't a quick fix. They're talking significant work into 2026, 2027, maybe even beyond, depending on regulators.
That timeline is key.
It really underscores the depth of the challenge, doesn't it? The sheer scale of fixing something like this. On a brighter note for the U.S., though, they did get an outstanding CRA rating again. Community Reinvestment Act. They've held that since 2014.
That CRA rating is important, actually. It's a good counterpoint. It shows that even while they're doing this massive internal cleanup, their commitment to the communities they serve in the U.S. remains strong. That matters for reputation, for long-term trust.
Definitely.
But honestly, that multi-year remediation timeline, that's probably the single most critical thing for anyone following TD to grasp right now. It just speaks volumes about the cost and complexity of modern financial regulation. It demands huge investment, yes, but also a real cultural shift inside the bank.
Okay, let's move to wealth management and insurance. This sounds like a much happier story. Strong underlying performance here.
Yeah, definitely a bright spot.
Net income up a whopping 63% year over year, $703 million. Driven by record assets and wealth, good insurance premiums, fewer catastrophe claims. TD Asset Management held its top spot in Canada for institutional asset management, pulled in $2.5 billion in new mandates.
Nice.
Their private wealth is consolidating offerings, making it simpler for clients. And TD Insurance, digital adoption is over 75%. Their mobile app is top-rated in Canada for home and auto.
So this segment is really humming along, leveraging market gains, sure, but also clearly benefiting from strong client engagement, especially digital. That move to unify private wealth offerings suggests they're focused on improving the client experience, making it more seamless. And that digital leadership, well, it shows their tech investments are paying off.
Good point. And finally, wholesale banking. Solid revenue growth here, too. And they're jumping on the AI train.
Interesting.
That income up 26% year over year, $398 million reported, $423 million adjusted. Revenue popped 15% to over $2 billion, driven by growth in global markets and investment banking. They even got an award Best Bank for DCM in Canada from Euromoney. But maybe the most forward-looking thing is the launch of the TDS Virtual AI Assistant, a generative AI tool for research.
Yeah, that adoption of generative AI in wholesale is definitely worth watching. It signals they're thinking about the future, looking for ways to boost efficiency and maybe even client interaction. It's not just managing the present issues, they're investing in future tech. It shows a commitment to innovation right alongside the remediation efforts.
Right, a dual focus.
Yeah.
Okay, let's shift to the foundations. Capital, credit quality, digital trends. How are they looking there? Capita seems solid. CET1 ratio at 14.8%.
Very solid.
Even with the share buybacks and those U.S. restructuring losses factored in. Leverage ratio, 4.6%. Liquidity coverage ratio, 138%.
Those are strong numbers, absolutely critical. It shows they have the resilience and capacity to handle shocks, but also the flexibility to keep pursuing these strategic changes. In today's economy, you need that strong capital base. It's fundamental for confidence, investor confidence, regulatory confidence. It proves they have the financial muscle for this overhaul.
And credit quality. Total provision for credit losses, PCL, actually went down quarter over quarter to $971 million.
That's positive.
Impaired PCL was lower too, reflecting overall strong credit performance. Performing PCL also decreased, mainly because they adjusted some overlays for uncertainty around policy, trade, and the economy. Gross impaired loan formations did tick up a bit from Q2 due to a few specific borrowers, but overall PCL ratios actually improved in most areas. Like in Canadian P&C, it dropped to 31 basis points from 44.
Okay, so those PCL trends suggest things are relatively stable on the credit risk front. They're being prudent, adding overlays for uncertainty, but the underlying credit quality doesn't seem to be broadly worsening. That's a good sign, indicates good risk management, which is crucial when you're navigating so much internal change.
We also got some detail on specific portfolios people watch closely. Commercial real estate, CRE, it's about $99 billion. 10% of their total loans.
Yeah.
But they stress it's diversified. Office space is only about 1% of total loans. And the 5-year average loss rate is low, 8 basis points.
Lower than their broader business loan average, yeah.
Right. Then Canadian mortgages, RESL. Huge portfolio, $407 billion, but very strong quality. Average impaired loss rate over 5 years is tiny, like 1 basis point. They also flagged industries exposed to policy and trade uncertainty, about $87 billion. Mostly auto, manufacturing, agriculture. They've set aside about $600 million in allowances just for that uncertainty.
That kind of detail is helpful. It shows they're managing exposures carefully, especially in areas like CRE that can worry people. The low loss rates in Canadian mortgages, the specific allowances for trade uncertainty, it points to a proactive, maybe even conservative approach to risk. Provides some reassurance.
And finally, digital adoption. You mentioned it earlier, but the numbers are pretty striking across the board, aren't they?
They really are. It's a consistent theme.
Canadian P&C, 85.4% digital adoption, up over 800 basis points year over year. Mobile users up over 8%. U.S. retail, 66.1% adoption, up 140 basis points. Mobile users up 2%. And home and auto insurance jumped to almost 76% adoption, up 1,320 basis points. End-to-end digital sales up 52%.
Yeah, that's a clear win. It just shows customers are shifting how they interact with the bank, moving more and more to digital channels. And that usually means more efficiency for the bank, more convenience for the customer. It's a key sign they're adapting well and that their investments in digital are bearing fruit. It's crucial for future relevance.
Okay, nearly there. Let's quickly touch on the economic backdrop and sustainability. What's the view from TD Economics?
Well, broadly, they see a global slowdown coming in calendar 2025. Blame it on, easing momentum, those ongoing U.S. tariffs. Inflation expectations are up a bit.
Okay.
For the U.S., they see growth slowing, staying below 2% in 2025 before maybe picking back up in 2026, helped by potential tax cuts and lower rates. They expect the Fed funds rate to come down to the 3.75% range by the end of 2025.
And Canada.
Modest growth in 2025, maybe even a contraction in Q2 this year. They expect the Bank of Canada to cut rates more aggressively, down to 2.25% by the end of 2025, and the Canadian dollar, hanging around 73 US cents.
So a bit of a cautious outlook.
Yeah, it provides the context, right? TD is making all these big changes against that backdrop of global headwinds, but also positioning for a potential recovery later. It's a reminder that strategy happens in the real world with all its economic uncertainties.
And quickly on sustainability and community stuff, it's important not to forget that. Even amidst all the restructuring, TD Bank in the U.S. kept that outstanding CRA rating, which is significant.
Hold it since 2014, yeah.
Shows ongoing commitment to financial literacy, affordable housing, local businesses. They also got an award for responsible AI from Data IQ. It's the 30th anniversary of their community leadership scholarships, over $30 million given out over the years. And TD Securities was involved in advising on a carbon hub sale, showing engagement in the energy transition space.
Right. It's a good reminder that these big institutions have a broad footprint, impacting society in many ways beyond just the financials.
So wrapping this all up, what have we really seen in this deep dive into TD's Q3? It feels like a bank making some really bold, almost aggressive strategic moves. Shedding assets, cutting costs hard, but also pouring huge resources into fixing regulatory issues, especially in the U.S. At the same time, pushing ahead with digital, with AI. It's complex. Resilience, adaptation, transformation, those words come to mind.
It's a story of tackling legacy issues head-on while simultaneously trying to build for the future.
Exactly. So here's a final thought for you, the listener. If TD's Q3 is kind of a snapshot, it really highlights this dual challenge, doesn't it? On one hand, this intense, rigorous cleanup of past problems, rebuilding trust. On the other, investing heavily in the cutting-edge AI, digital platforms to drive future growth. What is this period of intense internal re-engineering happening against this backdrop of economic uncertainty? Tell us about where global banking might be heading in the next 5 years, especially for the big players who manage to master both that tough discipline and bold innovation. Something to think about.